You curious about owning and operating a boutique motel in a short-term vacation rental market like Myrtle Beach, South Carolina? Well, today on site, we are at the Towers Motel right off of Ocean Boulevard. I'm going to show you how this hotel operator bought this motel for $1.2 million and just got an appraisal at $4.5 million. We're also going to look at a pro forma so that you can see 6 years owning and operating it, what you can resell it for, how much you can pay for it, how much money it generates, what your operating expenses are, and I'm even going to give you a quick tip on sellers' discretionary earnings so that you understand how to read between the lines on those financial statements when you're looking to do an investment. Now, additionally, guys, I'm also going to show you an interview with the owner. He has been in the hotel business for over 60 years, since 1970. Yes, you heard correctly. Him and his family have owned many hotels, and they know about this business. He's seen Myrtle Beach seasonality unlike many others. I'm also going to take you on a walkthrough of the units. We're going to go into the office. We're going to walk through some units. You'll get a full deal breakdown with financing information, reversion information. You'll also see uses and sources of funds. Basically, I'm going to give you the full deal breakdown so that you understand what this investment can do for you. Now hit that like button, hit that subscribe button, and let's get into the video now. You'd like to invest in commercial real estate. I'd like to show you how these properties make profit and break down all their expenses so you understand how they operate, how they appreciate over time, and how this will impact your taxes. I'd also like to let you know the property's cap rate and how it compares with similar properties in the market, how the location best services its users, and the potential for future growth. I'd like to fill you in on the historical and future occupancy trends, as well as potential management structures affecting the investment. And we won't miss the investment's risk profile nor the best exit strategies. Yes, we'll cover the condition of the property, any value add potential, and repositioning, but we'll also dive into special topics like customer base, market positioning, and marketing and booking strategies when it applies. And if you stay tuned until the end, I'll show you my top picks for the best commercial real estate deals that have generated the most annual profits, have the highest appreciation, and the best tax implications. So no matter if you're a first-time investor or a seasoned professional transitioning into the real estate game, or perhaps simply a casual investor looking to relocate to the beach to live, play, and invest so that the passive income can support you in your retirement years, whether you have 20% to pay down because you're financing or you're a cash buyer, if it's a commercial real estate investment that you're after, you'll be better because I'm aiming to give you a 10 times return on your time for watching my videos until the end. All right, guys, we are just outside of the Towers Motel. That's what's right in front of you off of none other than Ocean Boulevard in Myrtle Beach, South Carolina. You can kind of see both ways. Across the street here is the Shelby. Just down this way is the Atlantica. That's the Atlantica, that yellow and blue building. And this yellow building here, this is the Camelot. Right there. And then this intersection, I don't know if you can see it well. Trying to get a good zoom. You can't really see it just well. But that intersection, in my opinion, is the heart of Myrtle Beach. You are just minutes away from Broadway at the beach, the airport, you name it. The location is phenomenal. You're close to the Country Music Festival. Now, it says, welcome family, couples, Ocean View Suites. Their niche market is families and couples, budget-friendly travelers that don't necessarily need to be oceanfront. I'm going to take you around the outside of it. As you can see, that's the front office there. We've got units up above. You've got units here. We've got parking over here. as you can see. Yeah, parking out back, as you can see. The towers. You got a parking deck across the way. There's another motel here called Finn's Inn, directly back behind it. Now, this separate building is also part of the Towers Motel. Let me just show you real quick. This is your laundry, your drink machine here, as you can see. This is the main building, and then to the left is another building with additional suites and the pool deck. As you can see, here's our pool. Yes, they do grill, as you can see. They will grill hot dogs and hamburgers and chicken, all kinds of fun stuff for their guests, which is a really nice, cool little touch. There's your pool. There's that second building there. You can see that they do have tables and chairs out. Plenty of areas to lay out. And during peak season, which is April through September, this is a very popular stretch that is filled with thousands and thousands and thousands of people. So people enjoy people watching right here from this deck. That's why these are set up this way, facing the sun. They can get sun and people watch all at the same time. And that's the front, guys. Towers Motel. Let's get into this. All right, guys, check out the front office. But before we get in there, I want you to see 1805 North Ocean Boulevard. He is in the north end of Myrtle Beach. Now, this is the front office, as you can see. Got another door here. Seating area. They've got some brochures up front here. And then, of course, front desk. Now, this is the maintenance area, as you can see. To our right, we do have another area we'll get into in just a minute. This is going to be the laundry area for the on-site staff that takes care of all the linens and turning the rooms over, as you can see here. They got another exit door here. And, of course, laundry for days. They have a kitchen here, flat top, as you can see, sink, and of course, plenty of area to sit here. This is going to take us right back outside. I believe Myrtle Beach commercial real estate creates wealth differently than residential real estate because value is driven by income, operations, financing, and strategy, not just comparable sales. And in a market fueled by tourism, population growth, redevelopment, and migration, investors who understand how to improve operations and position assets correctly can create value far beyond what the average buyer sees on the surface. I believe Myrtle Beach's combination of tourism, retiree migration, and residential growth creates a unique commercial real estate environment where hospitality, retail, multifamily, and mixed-use opportunities can all benefit simultaneously. Commercial real estate isn't just about buying property. It's about controlling income, leverage, tax strategy, and long-term wealth creation. Before you buy a hotel, multifamily property, retail center, development site, or mixed-use asset, let's break down the numbers the right way. Net operating income, debt structure, value add opportunities, exit strategy, and resale positioning. Call me now at 843-360-1737 and let's structure a commercial real estate deal that works for you from acquisition to exit. All right, Joe, talk to me about what made hotels such a good business for you over the last 50 years.
Oh my goodness, it's been a pleasure meeting all the new people. It's been a very successful adventure for us. We've catered mainly, tried to hold to the family guests, and now we're into the third and fourth generation of those same families which we started out with back in the 70s. So there's a lot of benefits in just catering to the families and couples, and that's been our kind of our go-to goal through the years.
For sure. Now, were you able to create any wealth here with this boutique hotel?
We've had a very successful life. We've put numerous kids through college.
Come on.
We bought some farmland. We have other rental properties. So yeah, it's been advantageous for us.
Wonderful. And now you didn't take the approach of flipping like many other investors do. Why not?
Well, we didn't. We wanted to. We're working folks. We wanted something to occupy our time in a positive way, and so we didn't buy in with the idea of flipping it in a year or two. We bought into the Myrtle Beach family vacation, and we went to work.
Yeah, it sounds like it. I mean, over 60 years of hotel experience.
That's right.
Come on.
That's right.
And plenty of it right here on Ocean Boulevard. Now, what separates successful hotel owners from those who fail?
Well, I mean, there's failure in anything you go at. So you got to have that no quit attitude and just push through. You're going to have negatives and you're going to have positives.
Did you have some bad years?
Yeah, we've had some bad. COVID was not a friend of a business area in Myrtle Beach anywhere, really. But we pushed through and we survived. It's that just not give up attitude you got to have in business.
Yeah. So, all right. So, but you obviously had many better years than bad years, right?
We've had. Myrtle Beach has been very good to our family. We go back. I can go back with my aunts and uncles and grandfather. We actually go back to the 40s.
Wow.
Having beach property.
Now, yeah, I think oceanfront condos or the oceanfront idea of vacationing here started around the 1930s.
Right.
And so you've seen Myrtle Beach really evolve.
I have. When we bought in, a 6-story building was high rise in Myrtle Beach. So,
Get out. And now today we have what?
You got 23, 24, 25 stories, and they're continuing to go up as new things are built.
Now, this particular property, the Towers Motel, why did you buy this one?
Its location. We've always liked. We've had numerous hotels. We've liked the north end a little better than the south end, not for any particular reason. It's just been where my grandfather started out.
Yep.
And it's been good to us. We stuck to the north end. When I was looking for properties, this one had a great ocean view. There was a lot of things being done in the city with new building. The Camelot was being built at that time, so it worked out great for us. We ended up with a better view than what we had when we bought it. When people come to the beach, they at least want to see the beach.
No
Not
doubt.
everybody cares to be on Oceanfront. There's times when Oceanfront can demand higher prices than Second Row, but we're able to survive with a good clientele, and people enjoy seeing the same folks when they come back. It's like a vacation reunion for a lot of them.
Oh, so you have a lot of year after year repeat guests?
We have a lot. That's pretty much 99% of our
Wow. So you've got a solid book of business on this property.
Right.
Wonderful. Now, you've introduced a slew of topics that I have to pick your brain about. Now, all right, let's talk Ocean View versus Oceanfront, because that's what's controversial in a lot of investors' minds. A lot of investors think if it's not Oceanfront, don't buy it. Obviously, you stand here with 20, 30 years of proof in this hotel that Ocean View works and Ocean View builds wealth here. Could you shed light on any major takeaways around that idea? Should an investor be so focused on Oceanfront that they skip over the potential of Ocean View second row deals like this?
Well, I think Ocean View is a deciding factor if you're going to buy second row. You at least need the Ocean View. You need good beach access. The boulevard at times, it's a very entertaining street. People like to people watch. So they gather up and they sit on our pool deck and they just sit out here all day and watch people going back and forth on the boulevard. And you can have the Ocean View as well. So it's I understand some people just want Oceanfront, but there is an opportunity on second row to have ocean views.
Yep.
And second row properties, smaller properties usually have a pool area that's not as crowded. There's nothing aggravating than getting a jacuzzi and some little kid comes splash down in the middle while you're in there with your wife or whatnot. So smaller properties, not as crowded. It has its positives.
Yeah. So my question is there a secret niche section of the market that investors that are focused on Oceanfront look over and miss? Like, are these the more budget friendly guests that don't care about being Oceanfront, but they're maybe more stable and they're coming year after year after year, rather than with Oceanfront, you're having to catch new guests every single year. It's a lot more work. What do you think about that?
Well, you have to price. You can price yourself out of any market. Second row, we do. Our prices are not. We're probably below some of the bigger resorts, but we're above a lot of them. Just because you can't give away your stuff and survive in the market.
Yeah.
We've been at it for over 30 some years and we've survived. So we understand you got to pay your bills and you make money as well.
So there's a certain quality that you bring to the guest service here that maybe a lot of other second row or further back even hotels aren't bringing.
Right. We like to value our guests. Every guest is a opportunity for profit, and we treat them as such. And when they walk in the door, if it looks like somebody's going to take away from that value, we will ask them to leave.
Come on,
quickly.
Get it.
And that's just the way. That's just business.
That's
right.
What
you have to do.
Come on.
And our families appreciate that. I've been told some ruckus on the pool deck. I've asked people to leave, and I've had just people tell me, "Thank you for doing that. Thank you for doing that." They don't get that in these bigger places.
No doubt. So, what has changed the most in Myrtle Beach hospitality since the 1970s? I mean, you've seen this place evolve and grow.
In the 70s, I could probably name all the families on the north end who were in ownership. Now corporate has come in. You have you don't have the level of management that you had back in the 70s and even 80s, early 90s. It's all people. It's corporate. The owners, they might visit once a year. They might not.
Yeah. So is that a good sign for our market that we've got so much interest?
It puts a unique opportunity in a smaller place like this that is management by the owner, where the owners are in and out every day, not necessarily living there, but they are connected to the business.
Yeah.
And in a real way, not just a paperwork way.
Exactly. Now, are you concerned about oversupply? You've been here since the 1970s. You've been in business for years here. Are you concerned that maybe there's too many oceanfront hotels, or this market is saturated, or is that even real for you?
Well, you can't worry about the market. You have to worry about yourself, uh, and continue to put your customers first, and you'll survive. If you let the overall market consume your management skills, then yeah, there's gonna be competition. You got to figure out a way that you can be competitive.
Have you ever beat anybody? Come on, give us a story or something. Come on. Have you ever been in a dog fight?
At one time, we had in my brothers and sisters, we had 6 hotels, so there was a lot of competition between brothers and sisters.
Sibling rivalry.
And Christmas time was always very interesting, we'd say. But yeah, the competition among our family has been fun, and that keeps everybody, it keeps the cutting edge, it keeps the razors sharp. So
No doubt, absolutely. That competition, that free market
That's right.
is how this thing rolls.
That's right.
Now, Kelly,
Yes.
talk to us a little bit about some of what you see as far as tax advantages. Just a quick shift. Tax advantages for somebody potentially wanting to go after that value add route on a boutique hotel right here, Towers. Talk about that a little bit.
Yeah, so we there's obviously a lot of older hotels that can kind of fit that bucket of, you can register something like this with the National Registry, in which that is going to give an owner or an investor a tax advantage in any type of remodeling or things like that they want to do to the building, as long as they preserve the historical significance of the exterior. They don't do any major changes. There's a lot of these older hotels that are nostalgic and charming and have that flair to them that are really, really attractive to some investors that are coming into our market. It's really a need, honestly. And if you can also, obtain some sort of financial advantage.
Well,
I
yeah,
mean,
and let's just dive into that. So Kelly was mentioning off camera how there's another hotel
Yes.
that recently took advantage of
They did.
the historical tax credits. Now,
They did.
diving a little bit deeper into that, essentially, if you were to rehab this building back to its more historical date, and the building is at least, from the 1950s or older,
Yeah.
you can get these national and these state level historic credits. Now,
Absolutely.
these credits can be sold on an exchange for cash for you to inject in your deal.
Yes.
Which presents, obviously, that gets a lot of people excited, one. And then two, if you're a high net worth individual and you're making lots of cash, well, those tax credits could be very, very valuable for you to come in and do a project like this just to reduce your W-2 income or your small business income, or however, those losses can actually help out a lot. So
absolutely. And there's different structure opportunities, obviously, based on the need with that. And then we also have the Bailey bill that comes into play that's going to offer those tax credits too.
Tell me about that.
And I believe it's a 10-year where it sort of freezes the current tax rate, if I'm not
okay, that's right.
if I'm correct, and
Yep.
It freezes it for about 10 years. So obviously, we all want to keep our taxes lower. That's more attractive. So if you're coming into a property like this and you're adding some renovations to it, that taxable value is going to increase, right? But with this bill in place, it's actually going to freeze it from where it currently stands for 10 years.
It's a nice advantage.
It's a lovely advantage.
Yep.
And so you know exactly where you're going to stand from a tax standpoint for a longevity, a long period. And if anybody, if they wanted to pass it along to a new owner, you can actually freeze that for a new owner, which also looks attractive if someone's coming in to take over, do some rehabbing, and then wanting to maybe sell it. That taxable rate is locked in for 10 years. So that looks good from a resale standpoint.
And a lot of investors, they're not going to hold the property more than 10 years. Unless
Right.
you're going to come in and be an owner-operator,
Right.
then, knowing what your property taxes are going to be for the next 10
Huge.
years
It's
is
huge.
absolutely
Especially
huge.
when you have as much land as you have here. I mean, obviously these older hotels, they don't go up, they go out. So you have more land mass too, which is another positive thing to have whenever you have something that's been around as long as the Towers has been.
I believe understanding Myrtle Beach seasonality is critical, because investors who know how to structure around peak season cash flow, off-season operations, and tourism demand patterns position themselves differently than those buying strictly on annual averages. I believe the strongest commercial investments in Myrtle Beach are often tied to population migration, healthcare expansion, retirement growth, tourism demand, and lifestyle-driven consumer spending. Myrtle Beach is transitioning from a purely tourism-driven market into a more diversified economic market, and commercial investors who recognize that shift early may position themselves for long-term upside. Buyers focus on the property. Smart investors focus on the deal structure, the financing, and the upside potential. Before you move forward on any commercial property, let's walk through the underwriting together. Occupancy trends, cash flow, cap rates, expense ratios, reserves, financing options, and value add opportunities, so you understand exactly where the risk and opportunity exist. Call me now at 843-360-1737 and let's analyze your deal before you commit capital. All right, guys, we're just outside of unit 105. It is a double queen unit, as you can see here. And a little bit of natural light. You've got table, chairs. You also do have flat screen. Your own AC unit. You have your own kitchenette, which is a massive plus, as you can see here. Refrigerator. Another little section just to kind of maybe take a seat and eat at. You have a closet in the corner here, as you can see. And you have your restroom. Tub shower combo, as you can see. Vanity, mirror, light. You've got it. All right, guys, let's get in unit 310. Now, this is a 2-bedroom suite. This is the first bedroom as soon as you walk in. There's 2 queens in here. You got some natural light. See a cool little accent wall, seating area. Get your closet right in the middle, which is pretty cool. Got your vanity here. Your bathroom here. Tile. Tub shower combo. Refrigerator to the right. You've got your kitchen just here, as you can see. Stove, microwave, sink. You have your second bedroom here with nice little seating area. You'd have a flat screen right up this way. And of course, guys, check this out. Not bad, not bad. And that is a beautiful ocean view just through, look at that. Of course, you get a full pool view here and a view of Ocean Boulevard. Let's get in unit 308. Now, this is your first bedroom right up front. Plenty of natural light, seating area, accent wall. You do have nice chest of drawers here. Closet area. Let's get into your restroom. This is a tub shower combo, as you can see. You got a vanity here, as you can see. Refrigerator, flat screen. Again, you've got microwave, stove, sink, your second bedroom, and an excellent view. Look at that view. Not bad, not bad, not bad, right? Come on. Absolutely stunning. Nice view of the pool and the on-site amenities. Excellent view of the water. You can see just through there. And Ocean Boulevard. I believe you should invest in commercial real estate in Myrtle Beach, South Carolina, because our market has been the fastest growing market out of the 150 most populated markets for the past 3 years. Over 90,600 people relocated to Myrtle Beach, South Carolina in 2023 alone. This means increased demand for commercial space like retail, multifamily, office, and industrial, and ultimately excellent annual profits and appreciation. Now, for retail, more residents equal more consumers equal higher rental sales potential. This drives up rents and occupancy in retail centers. For multifamily, Higher population boosts demand for rental housing, pushing rents up and lowering vacancy. Now, for office, job growth typically follows population growth, increasing demand for office space. For industrial, more people means more consumption and e-commerce activity, increasing warehouse and last mile logistics demand. Ultimately, the return on investment impact is higher rents, lower vacancy, and rising property values that drive higher net operating income and appreciation. I believe you should invest in commercial or real estate in Myrtle Beach, South Carolina, especially oceanfront hotels in the hospitality industry because of the 20 to 22 million tourists that visit our market each year, which is the #2 vacation destination on the East Coast. High tourism equals steady demand, making it one of the most visited beach destinations in the United States. Our oceanfront hotels benefit from consistent seasonal occupancy, premium nightly rates compared to inland properties, and repeat visitors including families, snowbirds, and golfers. If you're considering buying a hotel, motel, or short-term rental hospitality asset in Myrtle Beach, understanding seasonality, average daily rate, occupancy, labor cost, and operational efficiencies is critical. The difference between an average hotel investment and a great one often comes down to management strategy, operational structure, financing, and knowing where value can be created after closing. Call me now at 843-360-1737 and let's break down the numbers and identify where the real upside exists. Now guys, as you can see back behind me is the Towers Motel right here in the heart of Myrtle Beach tourism. We are right here on Ocean Boulevard. The beach is literally just across the street. I'm going to take a quick walk down to the Skywheel so you see how close Towers is to all the action. Now, I'm going to break down your deal details. Let's just jump right into it. You can see on your screen it says financial analysis of Towers Motel. We got property information. The property name is Towers Motel. It's in Myrtle Beach, South Carolina. It was built back in 1966. Your total square feet is 7,361. There are 2 separate buildings. The lot, it is on the second row from the beach, is 0.38 of an acre. Now, your unit mix, you got 2 different types of rooms here at Towers Motel. You've got 20 double queen rooms. Those are around 200 square feet based on my estimation. Your rent for the year, I've got you at $250,000. The property, safely generates $500,000 a year. All that being said, these are my best guesses, my estimates on what the property can do based on the current unit mix. These are projections I've put together. Now, you got $250,000 coming from your double queens. I've got your average daily rate at $57. It is a motel. It is second row. I think that might be a little bit cheap. That's not an exact number. That's just my guess. And I've got it at a 60% occupancy rate, which is pretty typical for Myrtle Beach. Now, next you have a 2-bedroom suite. There's 10 of those units, 300 square feet. We're looking at $250,000 in rent again with an average daily rate of $114 a night. Again, 60% occupancy rate. Now, operations information. On this deal, there isn't additional income. Sometimes when you own properties this close to the beach, you'll be able to collect additional income for parking. You could collect additional income for maybe advertisements, maybe on the side of your building or something. You put a billboard and do advertisements. Additionally, I have seen or heard about, oceanfront condo owners that need a place to store room keys. Off-site at their oceanfront resort, they go and pay somebody like a motel owner or something to be able to set up a little lockbox there on site and pay them monthly rent so that their guests can get keys and access and stuff like that. So there can be other income from these type properties for sure. In this deal, I didn't hear about any when I talked to the owner. So I'm putting it at 0 and we're moving right along. Operating expenses, payroll and labor, $100,000. That $100,000 is what the owner pays himself. Now, again, these are my estimates and my projections, based off of my best guess of how this deal flows and works from the information I had readily available. Utilities, $51,707. One thing to point out is, and I want to say this again and again, the property's not in a flood zone, which is going to keep your insurance cost a lot lower, which we'll get to in just a minute. Next up, insurance and taxes, $24,640. I was kind of shocked about the insurance cost. Property taxes on the property, which you'll see in just a minute, were around $21,000. Your insurance was really, really low. Again, he's not in a flood zone, and he's been there for years, and since 2003. So his insurance and taxes were a little bit lower. Operations and maintenance, $38,319. Sales and admin, $37,165. That's going to give you a subtotal of $251,832. And then you have your property taxes at $21,734. Moving right along, we've got growth rates. Now, I'm assuming, which is upcoming, I'm going to show you a pro forma for the next 6 years about how I believe this property is currently operating and what it could currently do. I'm also going to throw a quick caveat out here, which it's almost unbelievable. The owner of the property runs the property by word of mouth. He does not use any online travel agencies to secure bookings for his property. Yes, you heard me correctly. And he can make $500,000 a year just off of repeat book of business and word of mouth referrals. He doesn't use Airbnb. He doesn't use VRBO. He doesn't use booking.com. So what I'm saying, which you'll find out in just a minute, is if he can make $500,000 off of repeat business and word of mouth, if you add in Airbnb, VRBO, and booking.com and other online travel agencies, as well as additional marketing that you could be doing, you could see where this property could easily make substantially more income, hands down. All right, anyways, growth rates. I got your rent growth rate at 2.5% per year. I've got your other income at 0 because we didn't have any on this deal. I've got your operating expenses at 2%, a little bit less than your growth rate for rent. I've got your property tax at 1%, salaries and wages 1%. Really, the only person really getting a salary here is the owner. And then vacancy, I've got you at a 40% vacancy. 60% is pretty standard and typical for Myrtle Beach, but I will say that, there's properties out there that make 85% occupancy rates. I just got a text message from a client of mine that did her first oceanfront condo, and I think January through June, she's already at an 87% occupancy rate. So it's pretty clear that people do vacation here, and if you got a hot product, it is in demand. You can really have those much higher occupancy rates in that 85 plus range. Now, moving right along, your investment information. You got a holding period. We're going to assume that you're going to hold for 5 years. I've got your purchase price at $4.2 million. I've got your closing costs. Commissions, 4% of that purchase price, $169. That's going to be to your agents and your brokers for getting the deal lined up and done for you. Legal, $10,000 to look over contracts, paperwork, all that kind of stuff. Close your deal out. Due diligence, $2,000 for inspections, commercial inspections. So I got your total closing cost at $181. Working capital, I'm saying you need at least have about $20,000 in your account. The hospitality business is super seasonal here, which is, obviously it can complicate things from a financial perspective if you don't have money in the slower seasons to pay your bills and stuff like that. Now, let's just dive into that for a minute. I talked to the owner, right? And by the way, the Sky Bowl is literally just right up the street. I talked to the owner. He said he would have 1 month out of the year, the month previously, in some of the better years, in the month of May, he would make enough income to pay all of the operating expenses for the entire year for the hotel. Came right out of his mouth. He was talking to me. I didn't catch it on camera, but he did let me know that 1 month out of the year in the peak season, he could generate enough. And at that time, he was charging $200 a night per room. Now, it's pretty similar to what I heard another investor say, Matt Freeze. Matt Freeze said, on his oceanfront condos, he's an oceanfront condo investor in our market. It's the same game, short-term vacation rentals, either out of a hotel or motel or oceanfront. It's the same game you're playing. Just one's at scale and one's not. Now, Matt Freeze said June, July, and August, he makes enough money on his oceanfront condos to pay all of the operating expenses for the entire year, and the other 9 months are pure profit. All that being said, it's not too far off from what I heard this hotel operator say, who, by the way, has been in the business since the 1970s, so he knows what he's talking about. So, all that said, do I believe that you should be nervous or afraid that you won't have enough money to cover your bills during the slow seasons or shoulder seasons? Not if you work in your business right. Not if you're managing your money well. That's the reality. I mean, from what I hear from your best performers in this business, they don't have those kinds of problems. So if you're dialed into your market, you know what your market wants, you deliver a superior guest experience and the right product to the market, you shouldn't have those kinds of issues. Now, is it always smart to have working capital on hand? Absolutely. You always want to have working capital on hand. Moving right along, total cost of investment. So, if you got a purchase price of $4,225,000, you add in $169 for commissions, you add in $10,000 for legal, due diligence $2,000, you got $181 in total closing costs, you add in some working capital at $20,000. Now you've got a total cost of investment of $4,426,000. Your purchase price per unit is $140,833. Your total cost per unit, which includes all the commissions and legal and due diligence, et cetera, that's going to come out to $147,533. Now your going in cap rate was 7.61%. And that's your current net operating income divided by that purchase price. All right, it's getting a little windy, so bear with me. Reversion information. Your exit cap rate was 6.60%. So ultimately, I'm saying that the market's going to improve by about 1% from the time you purchase it over that 5-year hold. Now, given the fact that Myrtle Beach, according to U.S. News and World Report, has been the fastest growing market for 3 years consecutively, given the fact that baby boomers are retiring to the tune of 10,000 per day and they're moving to the beach, Myrtle Beach in Florida specifically, and that they figured out that in Myrtle Beach they get a lot more for their money than in Florida. They can have a better quality of life, get a lot more bang for their buck. Given the fact that new construction has exploded here and our population over the next decade is set to double, I believe it's totally realistic that your property can improve in value by 1% cap rate. You know, you can drop that cap rate by about a percent. I think it's totally doable. I don't think there's anything out of the ordinary here. And to kind of see how that plays out for you, your gross sell price, that's your year 6 net operating income divided by that cap rate, that exit cap rate, is going to put you at $5.578 million. Now you paid 4.2 for it ish, but if you can sell it at that 5.5, you are going to have to pay some brokerage fees. I've got you at 4% on that. After you pay those brokerage fees, your net sales price will be $5.355. And then if you don't buy this, cash only, if you buy this with financing, you are going to have to pay off a loan balance. Now, after you pay off a loan balance, which I'll get to in just a minute, you will be left with a net proceeds of $2.6 million. Now, let's kind of work through your financing information. The majority of our buyers are going to buy using financing. So, loan amount. I'm saying that the bank is going to loan you 65% of the value of the property. If you're paying 4.2 for it, they're going to loan you 2.7 and some change. That's a 65% loan to value. You're going to have to put 35% down on the deal to get into the deal. Now, the assumption here for financing is that your interest rate is 6.5%, and this is going to be an interest-only loan. So how that works is you're never paying down you're always going to owe the principal amount that you borrowed, basically. So that 2.7 will be there 5 years from now. You still owe that full amount. You're just making interest payments. It's that simple. Loan fees have got you at 1%. Your monthly payment is $14,876. Your annual debt service, you take that $14,000, you multiply it by 12 months out of the year, comes out to $178,506. And again, that loan balance is 2.7. So because it's an interest-only loan, you'll keep that loan balance there for as long as you have this financing locked in place. We're getting closer to that skywall. Take a look back behind me. Come on. Uses and sources of funds. Purchase price, again, that's $4.2 million. Closing cost, $181,000. Working capital, $20,000. Total cost of investment is $4.4 million and some change. Loan fees. I'm saying that you're going to have to pay 1% fee for the loan. That's going to be $27,463. If you add that into the total cost of investment, you are going to have a total of $4.453. Now, sources of funds. There's really only senior debt on this deal. There's no junior debt. There's really no other type of debt. You're taking one loan out, most likely from a local bank. If you need help getting commercial financing on a deal like this, there are plenty of local banks here that I can introduce you to, plenty of lenders that will be more than happy to write your loan. Your senior debt was at $2.7 million. That is 65% of that purchase price. Now, so your total debt, again, $2.7 million. Your common equity, guys, that's the amount of money that you have to pay down on this deal to get into the deal. That's going to be at 1.7. And then finally, your 4.4 there, again, that includes the total cost of investment and those loan fees. I believe you should invest in commercial real estate in Myrtle Beach, South Carolina, especially in multifamily properties because of the strong rental demand from a growing population. The city's population grew by over 20% just in the last decade, with a significant portion of new residents moving here due to the low cost of living, warm climate, and access to beach amenities. I believe you should invest in commercial real estate in Myrtle Beach, South Carolina, especially in multifamily properties because of the tourism-driven economy. Tourism accounts for over 25% of the region's economy. The demand from tourism-related workers ensures a steady flow of renters in multifamily units year-round. I believe you should invest in commercial real estate in Myrtle Beach, South Carolina, especially in multifamily properties because of the affordable property prices and high cap rates. With an average cap rate for multifamily properties being typically around 7 to 8%, our market is higher than national averages for coastal areas, offering strong rental yield potential. I believe you should invest in commercial real estate in Myrtle Beach, South Carolina, especially in multifamily properties because of the potential for value-add investments. Many properties near the coast have strong locations but may be underperforming due to outdated facilities or lack of amenities. Renovating these properties can create significant upside for potential investors. You're a business owner thinking about purchasing commercial real estate for your company. The right property can reduce long-term occupancy cost, create equity, generate tax advantages, and strengthen your overall balance sheet. Before signing a lease or purchasing a property, let's compare your options and structure the deal around your long-term business goals. Call me now at 843-360-1737 and let's build a strategy that positions both your business and your real estate to grow together. Now guys, I'm even closer to that skywell. Look how close it is, all the action. All right, let's go through our pro forma on this. Your gross rental income. All right, now let's kind of break this down. I've got you at $833,333. In other words, that's the full potential you could make renting this property out with 100% occupancy. Obviously, it's not at 100%. Essentially, you got to account for a 40% vacancy. So $333,000 essentially is projected is sitting on the table. It's just that simple. So if the property is ran by repeat business, which it is, and word of mouth, because the owner told me so, if you added in online travel agencies and did additional marketing, do you believe that you could increase the occupancy on the property? I think so. Could you get to 75%? That's another 15%. Could you get to 85%? I mean, just imagine adding another 25% rentals to the books. I'm just saying, like, if the business models ran off of word of mouth, it's totally possible, highly likely, that if you added in online travel agencies, you would absolutely crush it. You'll definitely secure, in my opinion, more rentals than if you didn't have online travel agencies. Everybody at the beach uses online travel agencies. It's a no-brainer to me. Now, all right, so you factor in vacancy. You got 833. You take out vacancy, you're left with $500,000. I talked to the owner. He said that's totally reasonable, making $500,000 a year on this property. Operating expenses, we've got property taxes at $21,000. Other operating expenses, essentially, we've already covered them, so I just grouped them together. $251,832. Reserve, I'm saying you need to set around $5,000 a year aside just in case. That's going to leave you with a total operating expenses of $278,566. Now, if you have effective gross income of $500,000, you take out total operating expenses of $278,000, you are left with a net operating income of $221,000. But this is what I want to factor in. As an investor, you don't need an owner's salary unless you plan on running the business and want to pay yourself $100,000. So there's an extra $100,000 sitting there in a line item that we call seller's discretionary earnings. So ultimately, and this is just a part of it, it could be a lot of factors to sellers' discretionary earnings. There could be vehicle expenses, there could be salaries, there could be interest expense, there could be loans tied to the business that are more like personal loans and won't transfer with the sale of the property. Depreciation is a part of it. I didn't go into all of that, but what I did want to point out to you is, if the seller's making paying himself $100,000 a year, and you're buying this as an investor, and you're not going to draw that $100,000 a year in salary, well, guys, guess what? You can add that to your bottom line, and if you do that, I've created something called adjusted net operating income to account for that extra $100,000, adding it back in, because it's currently an operating expense. But really, if you're not paying yourself that $100,000 in salary, that can hit your bottom dollar. So if we've got a net operating income of $221,000, we add it back in that $100,000 from the owner's salary, we're left with an adjusted net operating income of $321,000. Now, your annual debt service was $178,000 a year. So if I've made $321,000, I take out $178,000, I'm left with an equity cash flow to the tune of $142,000 just in that first year as it sits. That doesn't take into account any of the growth rates that you see in years 2, 3, and 4. You can see year 2, that 833 jumps up 2.5% to 854. And then in year 3, it jumps up again to 875. Those operating expenses jump up a little bit too, by 2%, using all of our growth rates that we've already talked about. So you can see here, owning this over 6 years, that equity cash flow starts at $142, goes up to about $189,000. Now, guys, we're right here at the Skywell. As you can see, we're in the middle of all the action. That was not a very long walk. You got your arcades here, you got all kinds of shops all around here, you got Ripley's, you got all kinds of stuff. And in fact, the boardwalk is literally just right there. I'm going to start walking back. Now, how close is that? I'm just saying. It's in the middle of all the... It's right here. It's right where you want to be for Myrtle Beach tourism. Now, cash on cash first year, that's 8.37%. Now, you'll see down at the bottom, I've got their total cash flow and returns. Now, that's going to be There's an unleveraged, which means using cash to buy the entire deal, or there's leverage, which means using financing to buy it. So we're going to look at the cash flows from the deal from a purely, I bought this thing outright with with cash only, or I contacted my lender and I financed it. So unleveraged, first you got to put in $4.4 million to get into the deal. It's the total cost of the investment. Then every year you got a cash flow of 328 the first year, 336 the second year, 343, 351, 359, and finally in that sixth year you're going to sell the property. That's based on our assumptions. You're going to sell it for the whopping, I think it was 5.7. Excuse me, let me see real quick. I want to know. What do we got as a sales price on here? Oh, 5.5. Excuse me. You sell it for 5.5, pay some brokerage fees. Plus you got that year's cash flow to add in. And you got a nice bang right there at the end, hopefully for 5.7. That's going to give you an internal rate of return on this deal on those cash flows to the tune of 10% when it's unleveraged. Now, when it's leveraged, which a lot of people think is the smarter route to go, why would you sink $4 million in a deal when you could only sink 1.7 in the deal, use somebody else's money, and then use the bank's money to make money as your partner in the deal? A lot of people find that way smarter move. It is a little bit more risky. What are you going to do about financing in year 5 if you want to keep it and you don't want to sell it? You got to go get more financing. What happens if the interest rates are higher? Then you could end up upside down in the deal. There's obviously risk associated with every deal. These are things that you need to be thinking about. Now, leveraged, we've got 1.7 in the deal. That's the equity down payment. It's a common equity in the deal. That's your down payment that you're going to have to pay to get into this deal. So that's coming out of your pocket. That's why it's negative, because you're spending that money. Then after annual debt service, you got net operating income minus annual debt service is going to leave you with the equity cash flow. So on a financing, you pay that monthly payment, you pay that annual payment for the year, you're left with $150,000 year 1. Then 157 year 2, 165 year 3, 173, 181, and then finally you're going to sell the property. So you're still going to get that $178,000 in year 6, or some sort of version of that. If you sell it halfway through the year, it'll be half of that. If you sell it the first month of the year, it's obviously going to be a lot less. So you still get that cash flow from the time that you owned it on a pro rata basis, but then you got to factor in your net sale proceeds, and essentially that's your purchase price minus your loan balance. And in that year 6, that loan balance really hasn't changed at all. It's still that 2.7 mil, because you took an interest-only loan to finance this entire deal. It's that simple and that easy, guys. The internal rate of return on this deal is 16%. 16% if using leverage. Now, a lot of people will ask and go like, why is the IRR higher on a deal that has leverage and financing versus all cash? Well, you've got less money in the deal. If you have less money in the deal, the internal rate of return is higher. It's just that simple and just that easy. Now, there's 2 things I want to share with you really quick about this property. One, you can see on your screen there that there is an appraisal where I've snapped a picture of it on this property. The appraisal came back at $4.585 million. So the property has been appraised by an actual appraiser, and it's worth $4.5 million according to the appraiser. It's that simple and it's that easy. Now, all that being said, this is what I'm getting excited about. Myrtle Beach real estate makes money. This property was purchased back in 2003 for $1.2 million. The appraisal you just saw said 4.5. Let's do some math. I'm sorry, I'm getting excited and I just want to make sure it's right. So 4.5 minus 1.2 is $3.3 million. Now, let's do a little bit more math. 3.3 million divided by, okay, so let's do some math. Let's do 226 minus 2003. Oh, I did it the wrong way, guys. 226 minus 2003. 23 years. So 3.3 million divided by 23 years. Essentially, check this out. If he can get this property sold at what it's appraised for, which doesn't seem like it wouldn't sell for the appraisal value, properties sell for appraisal value all the time, he's basically made $143,000 a year just in appreciation. Not counting any annual profits, not counting any tax write-offs for owning and operating a hospitality business, not counting depreciation that he's got to depreciate this property every single year over 27.5 years if he uses the straight line method. Perhaps he wanted to do a cost segregation study on it and accelerate depreciation for all you high income earners. Or maybe you own a portfolio already and need some additional tax write-offs. So you do a cost seg study on this property. So the point is this, guys. $143,000 in appreciation every year, not counting annual profits, not counting tax write-offs. Now, a lot of people, they think about how the market turns. They think about the market going up and they think about the market going down. But they never take into consideration that the market is always trending up. Appreciation is always on an upward trend. In other words, yes, I can buy a property for $1.2 million, and next year it could be worth $800,000, which is less than what I paid for it. But appreciation is a timing issue. It's a timing game. So if I hold the property long enough, the market should recover, and because appreciation is always on an upward trend, it will recover better than what I paid for it. So as long as I got the time to play the game, and I play the game well, and I timed the market right, I can make great money. Now, it's obvious that's some nice appreciation on that motel, but that's not the only thing I want to tell you about. There was another hotel I did a video on, I think it was last year, called the Oasis Hotel. It was an oceanfront hotel. The point is this. I'm not going to make comments about it, but the point is this. The gentleman who bought that hotel made $4.1 million in appreciation. I want to make sure you can hear me. $4.1 million in appreciation on a hotel right here in Myrtle Beach, South Carolina. So, before you run off to the big cities, before you run off to New York or Florida or these other places looking for the best deals, the value buy and the money to be made is right here in Myrtle Beach, South Carolina. Myrtle Beach is the value buy. That's what it is. And if you do it right, there are plenty of people that become millionaires buying and flipping the right properties at the right time. It's about identifying opportunity. It's about running your numbers. It's about knowing your market. It's about not running after what everybody else is running after. Not flying off to the big cities where all the big fish are fighting over deals, and getting in the weeds right in front of you and finding the gold. So, all that said, guys, I hope you can see that Myrtle Beach hotels, Myrtle Beach hospitality, Myrtle Beach short-term vacation rentals, honestly, is where it's at. In this market, the money is to be made in short-term vacation rentals. Everywhere I look, I see lots of investors that are rising to the top, and they're making that kind of cash. Well, I won't say everywhere I look, but there are people that are making that kind of money right here under a lot of people's noses. I was just having a conversation with a commercial broker, even on this deal. We were out talking, and we're talking about the sea mist. These condos now are selling for like $60,000, $64,000 last time I checked. He was telling me somebody told him they bought one in the 50s. Oceanfront and Ocean View condos. Probably the Oceanfronts aren't that cheap, but the Ocean Views are in the 60s. The point is this. I had a client who had an Ocean View condo. It was an Oceanfront. And she showed me she made $33,000 in gross rental income renting that Ocean View unit out. Now think about it. If she's making $20,000 a year profit on a condo that costs $64,000, in 3 years she's got all her money back. She can go buy another one. I'm just saying. And a lot of people do have $50,000 to play the game. So what I see is from the smaller properties to the mid-sized properties, those triplexes, those duplexes, oceanfront condos, 1 bedrooms, 2 bedrooms, 3 bedrooms, 4 bedrooms, 5 bedrooms, to boutique hotels, 20, 30, 40 units. People are making money. The question is this going to apply to you? It's 843-360-1737. Pick up the phone. Stop sitting on the sidelines. Stop being afraid. You that are thinking about retiring at the beach and maybe owning a hotel to rent out while you live at the beach for your next chapter. You, husband-wife couple that thinks that's super fun and super, super cool. You, young person that wants to scale and build a portfolio and wants to learn the ins and outs of the business. Come on, pick up the phone. Give me a call. Stop sitting on the sidelines. 843-360-1737.